We have a great question here from Kerrick, asking about a trade that we're looking at today in the pound dollar. We're of course looking for a potential buying opportunity if we can see the pair moving back down to that 133 level. But Kerrick's question here is about the gap that we have, the overnight gap or the weekend gap, asking that should we be concerned about that gap in terms of that bullish bias that we have for the pair. So I think it's a great question, Kerrick, and gaps are something that it's a very common and frequent occurrence, so we can talk about it in a more general sense as well. And I mean, we can start with exactly, just looking at what a price gap is. A gap is essentially just the difference between the closing price of one candle and the opening price of the next, right? And the gap is simply just created when the price fluctuates enough between those two candles to create a gap in the price. Now, price gaps occur on many different time frames. As you know, it can happen from a 1 minute to the next. It can happen overnight. It can happen over the weekend, as in this example. And the market, it can happen for many different reasons. Maybe the market receives new information, or maybe sentiment changes, causes that market to gap higher or lower at the next candle or at the open. Now, these gaps can occur during trading hours when the liquidity isn't great, like on most 1 minute time frames, you'll spot a couple of gaps throughout the day, or it might occur in stock. So if we go to any stock chart, let's just open up Tesla, for example, you'll see plenty of these price gaps, obviously, because that's the difference between today's opening price and the prior day's closing price. And like we said in the pound right now, it was basically the good news that we had over the weekend and that saw a gap to the upside in the pound. So to your question, should we be worried about these gaps? Now, it really does depend on the sentiment. I mean, there's a lot of different schools of thought in the trading community that usually says things like, every gap needs to be filled, or the gap can't go unfilled, or something in those lines. But it's important to realize that there isn't really any rule in trading that says the market has to fill any type of price gap. There was actually a study done a while ago that I read in an article. I'll try and remember what website it is, and I'll get back to you on the name. But they did some research for this specific topic. And in the study, they examined something like 20 or 25 years worth of price data on, I think, the S&P. And they found that every gap of above 0.5%, so every 0.5% gap, was only filled about 40% of the time on the current or on the next day. And for all the gaps above 1%, it was even less. I think it only got filled about 30% of the time on the next day or that same day, which shows that it's not as common a reaction as most or some market participants claim that it is. I think what often happens in those circumstances is a little bit of confirmation bias, probably because they see a gap and they see price move to fill the gap, and they immediately assume or link the price move to the gap fill, when the price move, probably had nothing to do with the gap and everything to do with just what the sentiment was at that time. Because we programmed from a very early age, of course, to think in terms of patterns, right? So it's quite easy for traders to assume confluence or correlation means causation, but that's obviously not the case. The fact that the market filled the gap and the reason why the price moved in the first place to fill the gap is not the same thing. I think a great example, a recent one that we had on a larger time frame, is oil markets. So if we quickly go to the H4, we, of course, at the start of the year, just as the COVID crisis came, we had that price battle between Saudi and Russia, and we saw that massive gap on the H4 time frame. So a huge gap to the downside. And months later, eventually we came right back to that gap level where we did find a little bit of resistance. Now, those that overstate the importance of gaps will fixate on that and use that as a reason why the price moved. So, the price moved to fill the gap. But in actual fact, the prices didn't move higher to fill the gap. Prices moved higher because there was a drastic change in the supply and demand outlook as OPEC stepped in with massive production cuts. And at the same time, we had overall market sentiment also turning more positive for risk assets as central banks around the world threw in, everything and the kitchen sink to basically support their economy. So there's plenty of reasons why price move. And with those statistics in mind, it's not really a very common thing, and it doesn't move to fill the gap. It's not a correlation causation relationship. It's normally just a coincidence. Now, also do keep in mind that a gap, can occur in line with the overall market sentiment or bias as well, as is the case for the pound. So when that happens, it's usually a good sign because it shows that there's a lot of momentum, a lot of buying into that particular momentum, whether up or down for that particular bias. And of course, in certain circumstances, a gap can also create a great opportunity to use for fading purposes. If you know that the market has gotten ahead of itself, and you use that gap as a trade target, and basically wait for the gap to be filled. So to turn it into a practical example for today with the pound, am I worried about the gap for the pound today? Not really, because I think the sentiment is still in line. Obviously, if we do make our way back down to that 133 psychological level, what I'll do, as I always do, is I'll reassess to make sure whether the bias for the pound in terms of sentiment is still tilted to the upside, and whether the bias for the dollar is still tilted to the downside, because maybe at that time we start seeing equity markets coming off a bit, we start seeing bond yields coming off a bit, that sees a little bit of support coming back for the dollar. If those types of things happen and I'm at that level, I can always reassess and make sure whether the overall bias is still intact. But if I do think the overall bias is intact, nothing is gonna, I'm not gonna refrain from taking an entry at that 133 because I'm afraid of the gap being filled, basically, because that gap's in line with the current market sentiment. So it's not something that I'm looking to fade right now. But keeping those stats in mind that we mentioned earlier, just for practicality's sake, let's use that 40% for the S&P, right? Now, this was quite a sizable move, so it's probably something closer to 30% if we use that S&P example. So there's about let's say, in line with that S&P stats, there's about a 30% chance that gap will eventually be filled. It might not be today, it might not be tomorrow, it might be the next day or the day after that. But according to that stats, nothing stops us from playing a little bit more safer and anchoring our stop below that overall area. So, trading from this level will be in line with the current market sentiment. If we then feel that, we're a little bit anxious about that gap, possibly the market's looking to push it down lower, if that's the case, you can always just anchor your stop away from that gap, making sure that you allow yourself a little bit more breathing space in case the market does move, in case that is that 30% of the time when the market does fill the gap. Just to give yourself, a little bit of peace of mind for that particular trade. So hope that helps with the question there, Kerrick. Any other ones, as usual, please don't hesitate to let us know.